Hello, everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then, kind of based on what we're seeing there, make some decisions on what we're going to do as far as moving forward for the trade for the week or trade for tomorrow, let's say Monday, sorry. So, let's take a look at the past week. And obviously, we know what the past month and a half has looked like. It's taken this huge down, and now over the last couple weeks, it's kind of been around in this area. And even though I want to point out here, even though it looks like it's relatively stable because we had these huge moves here, right? And these don't look nearly as big. But here's what I want you to do. Look up here, right here, when I go over the date. And you see this is H and L. This is high and low. Okay, so what that means is that's the range for the day's trading activity from high to low, the highest point it got and the lowest point it got. So if we look back at one of these, let's say, huge days over here, and you look up there, you see high to low, 650 to 350. That's a 300 point day, right? That's like a 10% move in one day. Absolutely insane. And even though, if we zoom in the last week, right, these look not so bad. If we just pull over, let's say on one of them, let's look right here. So it says 2621 to 2445. So what's that? That's 180 points in one day. Okay, that's almost like a 5 or 6% move in one day. And even if we go to the smallest day on Friday, which looks tiny, right? Look, it says 2524 to 2584. That's a 60-point move. That's almost a 3% move in one day. And if you go back to even a few months ago, before this whole coronavirus hit and all this massive change has happened, 3% in a month, okay, would have been a big move. We're talking about 3% in one day, and now it looks relatively small. So don't be fooled by these moves and these little candlesticks. These are huge moves still on a daily basis. So with that in mind, that's why I'm keeping my trading very small and also changing up my rules, at least in this crazy environment. Because again, even though 45 days has proven out in history to be the best time window to trade in, that didn't include this kind of, you know, this kind of market where it was making these massive moves on a daily basis. 45 days to me at this point seems like an eternity. So even though researchers told me in the past stay in 45 days, well, this has never happened in my lifetime that I can remember while I was trading. So I'm going to change up some rules to see if I can't take advantage of this and not wait 45 days, because 45 days is, at least in my eyes, like an eternity at this point. So based on that, what are we going to look to do tomorrow on Monday? Well, again, I'm going to look at all the different indices. I always start with those. In a high volatility environment, I prefer to stay in indices. As you've seen, I've done oil. That's an indices. That's an index, right? I mean, it's a commodity or an index ETF. So if we look at the SPY, which is the ETF version of the chart I just showed you, which is the ES futures, you see it's the same. And you see down here, the volatility says 60%. And if I look at the Qs, you can't see it, but if you look over on this right-hand side, you see it says 48. IWM is 64, and the diamonds are 60. So essentially, IWM or SPY are the two highest volatilities. And since they're relatively close, I'm going to go with SPY only because it's more liquid. It's a more liquid stock than IWM, which means I get better fills. I'm going to get filled closer to my mid price. And if I go to the trade page, obviously there's a lot of choices to do. I'm looking around 30 days now instead of 45 because I think 30 days is a reasonable window. It gives us enough time for it to bounce around and still hopefully settle in at a price in between our two strikes if we do an iron condor. And the reason I'm going out here to 33 days as opposed to the other ones, and I'll show you why, is the strike prices. See here, I have a lot more choices, right? They're one apart for the most case, and they're kind of in a big solid range, and where I'm going to be looking in like the 210 to 230 range. If I look at the other months, you see they're kind of weird strikes. If I go to 31, you see here how they're like more like 5 apart in some places, 3 in other places. It's weird. Same with like 29 days. You see they're kind of all over the place. So because I want to try and go as close to 30 days, I'm going to go in this 33-day window because, again, like I said, there's just the most strikes to choose from, and they're all about the same liquidity. They're all like, let's say, 10-cent wide bid-ask spreads. But that's okay because we're going to try and get filled at mid-price. And if we don't, we're just not going to make the trade. So I already set this trade up for tomorrow to save us bouncing around. Again, I'm going to do what's called a chicken iron condor, which means I'm going to look to collect around 50% of the width of the strikes. So in this case, it's $2 wide on each side. So I'm looking to sell this for about $1. And why is that? It's because, one, the volatility is so high I can still go pretty wide on my strikes and collect a fair amount of credit. And because normally we'd look to do around 33 to 40 cents per dollar width on a normal iron condor, chicken iron condor we collect more. And in this case I can go really wide and still collect a decent credit. I prefer that because I don't want to risk as much, right? Because if it moves against me, it's going to move probably a ton against me. Whereas normally it might stay in a range. But as we've been talking about, this market is crazy. So tomorrow what's going to happen is when the market opens up, and right now it's at 248, and I skewed this slightly downwards, meaning I sold a call $20 away on the upside, $21 away on the put side to give it more room on the downside. And then of course I always buy the call and the put that are $2 away to create a $2 wide iron condor. In this case I'm looking to collect a dollar, roughly a dollar credit, anywhere between like 90 cents and 110, totally fine with. So all that's going to happen tomorrow when the market opens up is I'm going to look at this price. I'm going to go roughly $20 away on either side, see what my credit is at the time, and then start adjusting the strikes closer or further depending on what's possible until I collect about a dollar credit for that $2 wide iron condor. And that is our trade for tomorrow and why we were doing the chicken iron condor as well.